Hello, good morning from New York and a good afternoon from Brussels. I'm Bart van Ark and I'm the Chief Economist at the Conference Board, and welcome to our monthly Economics Watch by the Conference Board, which is a review of what's happening in the global economy, with today a preview of our global economic outlook for 2020, which we're actually releasing tomorrow, but as a attendant you are lucky because we're going to share with you the insights early on, as we always like to do with our members. So thank you for joining us, and we'll hope to hear from you during the course of this webcast. What we're going to cover today, before I introduce the panel this morning, is first of all sort of trying to answer some of the critical questions that I think are important right now. So the most important question we hear is, can a recession, or perhaps even a global recession, which we'll talk about a little bit more what that exactly is, can it actually be avoided in 2020? And what would it take for that to happen? A lot of the slowdown that we're currently looking at in the economy is driven by the decline in industrial production. Is that likely to come to an end? To what extent can labor markets and consumer spending help us to actually avoid a recession and pull us through a further slowdown and be able to sustain it in terms of positive growth? To what extent does all these geopolitical uncertainties that we hear about all the time, whether it is the China-US trade dispute, whether it is the Brexit, whether it is tensions in the Middle East, to what extent could that potentially trigger a crisis? And if we have time, we may be able to also talk a little bit about foreign trade and our long-term outlook, which is part of our regular outlook as well. So a lot of things to talk about today. As always, you can participate in this actively, and we'd like you to do that in multiple ways. First of all, you can ask questions during this webcast, and we strongly encourage you to do that. There is a chat box at the bottom left of your screen. And if you just type in your questions anytime during the webcast, we will try to weave them in during the conversation with the panel. Feel free to download the presentation via the file download pod. You not only will find there the actual slide deck, we also have a nice infographic that summarizes the headlines of our global outlook, so feel free to download that and share it with colleagues in your organization. You can switch between full screen and video in this webcast, and you do that by clicking the 4 arrows at the top right of the screen. There's a brief evaluation at the end. We always like to hear from you how we can improve on our webcast and on our Economics Watch program. And of course, you can share this program with your colleagues. It will be available on demand shortly after this webcast on our website. And then finally, as you can see on the slide right here, some of you will be eligible for earning credits. We have Cpe Credits available today. If you are eligible to that, type in your full name and email address in the space provided. Click OK for the free pop-ups that occur during the program. Stay online for the entire webcast. And the credit, of course, only available if you are joining us live, as you are doing right now. So we have a great panel. It's entirely a Conference Board panel today, because this is, after all, the Conference Board Economic Outlook, which is prepared by my colleagues. I'm joined by 3 of them who've been very important to this. On my right-hand side, that will be on your left, is Ataman Gilderim, who's our Senior Director in Economic Research here in New York. Ataman, welcome.
Good morning, Bart. Great to be here.
And then right on the other side of the table here is Eric Lund. He's our Senior Economist for the US and China. And is also the new anchor for our Economics Watch. So welcome, Eric.
Thanks. Good to be here.
You'll see a lot more of Eric in the coming months. And then we have our colleague from Brussels, Ilaria Marcelli, and she's our Senior Economist for Europe, of course, and we'll hear from here, of course, on the European outlook today. Welcome, Ilaria.
Thank you. Hello, everybody.
Good. So, as always, as I said, we'd like to hear from you, and we're going to do that this morning right away with a poll question, which should be appearing on the screen right now. And we're waiting until that is being posted. And the poll question is as follows. What is your expectation for the 2020 global growth rate over 2019? Do you think it will be up over 2019? Do you think it will be about the same? Or do you think it will actually go down? And this is globally, and we'll talk about individual regions a little later, of course. So I will leave it open a little bit more, and then we're going to close it in five seconds. 5, 4, 3, 2, 1. So slightly more of our audience thinks it will be down. A little less than 50%, 43% think it will be the same. And only one of you is actually thinking that it might actually go up. So it's not a huge amount of optimism on this webcast. We'll see if we can change it this morning. But Ilaria, let me start with you very quickly. Surprised, not surprised from your perspective?
Well, this is already better than the conversations that I have, because most people I talk to, they expect it to go down. So this sample is actually more optimistic.
Okay, Eric.
I think I'd love to see where these individuals that are voting are actually sitting at the moment. If you're in North America, maybe you're sort of maybe about the same. If you're in Europe, maybe a little bit lower. And that one person that's up, I'm wondering if they're in Vietnam at the moment.
So it's also the perspective from where you're sitting, whether you're more or less an optimist when it comes to the global economy.
I think so, yeah. I think so.
And I think also the sector you're sitting in might be important, as we will see, right? We'll see a lot of pressure in manufacturing, much less pressure in services. So that might also be determining the amount of optimism or pessimism that our audience may have.
Yeah, I think that's a good idea, a good observation that where you're sitting in the economy really colors your judgment. In general, I mean, this is really in line with what I would have expected the response to be, about the same, with a kind of a slightly downward pessimistic tilt. Although I personally would probably have responded about the same. So I'm not as pessimistic as our audience.
About the same. Okay, so let's see if we can become a little bit more optimistic than the audience, and whether we can convince the audience of that. And again, of course, I'll encourage you to put in questions and comments. Feel free to disagree. A forecast is a forecast, and it is there to debate it. So we'd like to hear also your perspectives. Let's try to sort of right away go into sort of the headline numbers here. This chart is actually the headline GDP growth rate all the way back to the 1970s. The gray areas are what we would call global recessions. You can see here that global growth actually has come down quite a bit since the last recession, which we had in 2008-09. And in our estimates is ending up at about 2.3% in 2019. And particularly 2019, this last year before the line becomes dotted, it's actually been taking a pretty big hit. We were at 3% in 2018, at 2.3% in 2019. That's a big decline of 0.7 percentage point over a year. The question, of course, is where we're going to go next year. Now, you'll find us a little bit more optimistic, actually, than most of you in the audience. We actually believe that a global recession can be avoided. We actually think that the economy may recover a little bit, and we'll talk a little bit about why we think that is the case. And very importantly, that in the longer term, the global economy will recover to a growth rate of around 2.7%, which is higher than it is today, although significantly lower than it was in the previous decade. So the global economy is slowing, but for next year, we actually think it may recover a little bit from the big hit that we have been seeing. Now, Ataman, before we go into detail, the big question, of course, is what exactly is a global recession? We sort of know what recessions are, when an economy is going to contract at a particular place, but we don't quite often see that globally, that the economy will contract.
Right. So, on a national basis, we have a pretty good definition for what a recession is. It's a sustained contraction in overall economic activity, but it's harder to define it on a global scale. I mean, we're really looking at about 200 different economies. They're all moving in different directions, and when you put them all together, as you see here, the global growth rate is pretty difficult to push into contraction territory, and there's not a lot of consensus on this, but that 2% line that we put in there is roughly what most economists that study this, most international organizations kind of think of as a recessionary threshold.
Yeah.
And when the global economy goes below that, as it has happened during those shaded periods, we would say the global economy is in recession, or in kind of a downturn, a major downturn. Of course, we see the global financial crisis, which brought us down to negative growth.
Yeah, that was an exceptional period
but that's very
global
exceptional.
Contraction.
In fact, most of those sort of below threshold periods are exceptional periods where a majority of economies around the world are into a deceleration or a downturn.
So admittedly, we're not very far from a global of that 2% line that would potentially be this global recession definition. The question, of course, is the big underlying question is what could potentially push us there versus what might possibly rescue us. And I think a very important insight that we are having in our outlook is, of course, that the decline in industrial production has been a key driver around this. And in this chart on the left-hand side, you can see global industrial production, U.S. industrial production, Euro area industrial production. On the right-hand side, You can see it for emerging markets and China as well. Eric, let me start with you, because I think China is a very important part of this story, because we've seen this industrial production decline in China. How and when did that happen, and how has that sort of infected the rest of the global economy?
Sure. Well, I mean, the downturn that we've been sort of watching in China this year really started last year. It's been a prolonged period of slowdown that in some ways is tied to China's work to try to address the overcapacity in a variety of sectors. So, as they worked to try to eliminate some of this overcapacity, it drove a sort of a supply-oriented slowdown in the economy, which really sort of started to spill over into other economies as well. For this coming year in 2020, we're actually expecting that growth to pick up a little bit. But certainly over the last 2 years, it's been a pretty strong narrative that overall GDP growth has been on the decline.
So when we talk to most companies, they actually say, yeah, we see that slowdown in industrial production, but we really started to feel it in 2019. And you were just saying that it actually started last year in 2018. So what happened there?
Sure. I think the slowdown really first started to affect local firms and smaller firms that necessarily aren't connected to a lot of these MNCs. So MNCs and larger global businesses started to really feel it this year, and maybe in the fourth quarter of 2018. But I think a lot of the pain was originally felt by smaller domestic firms in China.
Started upstream and then gradually worked its way downstream.
That's correct.
In the economy. And was it across the board in industry, or is it in particular sectors where we see
in heavier industries for the most part, certain commodity sectors as well. And it gradually sort of trickled from those suppliers down into the higher value-added foreign sort of dominated sectors in the economy as well.
And this is kind of happening in the larger context of the Chinese economy's transformation to a slower growth path, because they're moving from manufacturing and investment-led growth to consumer-led growth. And I think part of that, the mix of government policy is probably shifting to favor more sort of consumer-related sectors and less so for the large state enterprises that are in manufacturing and investment.
So I'm also wondering, Eric, I mean, you said a little bit of a silver lining here. We know that there was a huge amount of overcapacity out there, particularly in heavy industry. Is actually some of that overcapacity being taken out, and might that be a reason that we're actually beginning to see a little bit better growth in 2019?
I think that's a part of sort of our thinking for 2020. The overcapacity issue has been around for 5, 6, 7 years or so, and there's been a lot of talk over the last 5, 6 years about the need to actually address it. China's leadership finally has done that. It's come at a cost. Growth has slowed. But I think coming out of 2019 and into 2020, with some of these issues addressed, it's going to put them into a position to sort of re-accelerate growth in the coming year.
Okay. Now we'll come back to China a little later in this webcast. But Ilaria, let me talk to you and talk about the left-hand side here. The euro area has sort of taken a very big hit. To what extent is that actually related to the China story? Because we know that Europe is incredibly exposed, much more exposed to China than the United States, for example. So could it be indeed that the infection from China has impacted the euro area more than other countries, or is there more going on?
Well, that is definitely true, and you can also see that the blue line in this chart moves more than the orange line of the U.S., and that is because a larger portion of GDP of demand in Europe comes from demand from outside Europe. So this is why Europe is very exposed to any external shock, basically. Now, I think there is a mix of things happening here. There is, on the one hand, for sure, the fact that growth in China is weaker, and that and therefore we import the weakness somehow. But I think there is more than the trade-related issues and the trade disputes in general. I think there are also some long-term challenges for the manufacturing sector in Europe, and I'm thinking of the challenges related to the digital transformation. And just to give an example, think of the gigantic transformation happening in the auto sector, and we know how important the auto sector is in Germany and therefore in the euro area. So if you put the two issues together, you really understand why that line of industrial production started to drop so rapidly after the end of 2017.
Right. And you mentioned Germany. Is this primarily a Germany problem, or do you see that decline in industrial production happening across the euro area or even more broadly Europe as a whole?
It is more broad. It's not only Germany. Now, of course, the manufacturing sector in Germany is huge. It's more than 20% of the economy. And of course, not every economy has such a large manufacturing sector. Italy is the second biggest one. But if you think that Europe, or especially continental Europe, is a sort of one value chain around Germany, then you understand, of course, that the shock cannot only be a German shock.
Okay, well, again, we'll come back to Europe a little later in this webcast and go a little bit more deeply into this, and particularly in the Germany issue. But before we do that, let's stay sort of with the headline. So industrial production is a real problem, and the question is, do we believe that that is going to gradually bottom out, to the point of perhaps some kind of restructuring taking place in China that might help us to actually avoid a further decline in industrial production? The other part of the economy is, of course, the consumer. And there's a lot of good news. In fact, just this morning, we have a lot of releases this week. Just this morning, we released our Global Consumer Confidence Index. This is for 64 countries around the world. It's a quarterly survey. And we found, it's a little boring maybe, but over the previous quarter, over quarter two, consumer confidence globally has remained positive and well above 100. It means that it's about 107, which means that we have more positive consumers in the world than negative consumers. And that's of course very important, because on average, consumption accounts for about 50% of expenditure in 50% to 70%. It's 50% in developing countries. It's more like 70%, for example, in the United States. Now, what you see in this chart is a heat map. So here we're just looking at levels, and as in previous quarters, North America, but also Asia Pacific and parts of Europe have the most optimistic consumers. There's some movement across countries. For example, of the 64 countries, now 33, so that's just over half, are actually seeing a decline. And that's up from 29 in the previous quarter. So there is a little bit of movement there. Also, there is as part of this consumer confidence index, job prospects is one element of it. We do see a little bit more concern in job prospects, but again, it's on average really not a lot. So overall, it feels like consumers globally are sort of hanging in there.
Yeah, Bart, it's interesting to see that, when you look at Europe, Germany, which we were talking about earlier, is actually one of those warm spots in the global consumer confidence numbers. And, consumers are still kind of holding up, right? So their job prospects are supporting their view of the economy. That's not just Germany, though. We're also seeing that in many other places, especially in the US. And in fact, the next chart will show us that. That's our consumer confidence expectations index in the blue line, which has been at historically high levels, very consistent with continuing consumer spending. And it's highly correlated with the labor markets. So, job prospects are keeping that number up, even though it has, experienced more volatility. In contrast, though, what you see there is the latest number for our CEO confidence, which really took a big drop. And that's pointing to this divergence that we're seeing in many countries around the world, where consumers are holding up, but business executives are a little bit more on the pessimistic side. Possibly they're being kind of influenced or affected by the trade disputes. And also maybe the financial markets volatility is, they're more sensitive to that.
This is an unusually large gap, right, between consumer confidence and business confidence, frankly. I don't think, we're only here, we go back to 2006, but even if we go further back, you don't often see such a large gap of consumers actually being really positive. And just think about the very low unemployment rates that we have around the world, right? In US, in Europe, also in many emerging markets. So that makes consumers very positive. And on the other hand, we've got these business executives who are so concerned about these trade disputes. And I think in a way, consumers don't really care about these trade disputes until prices go up big way, or until they're going to interfere that this may cost their job.
Yeah, I was gonna bring that up as well, Bart. The wedge really that's driving these two lines apart, I think in a lot of ways, is the trade dispute that we're seeing. Businesses don't know how to plan for it. They're reevaluating their global supply chains. It's introducing a lot of uncertainty at the C-suite level. But at the consumer level, especially I think in the U.S., consumers have not felt these tariffs. Businesses have eaten them and not passed along the costs to the consumer. So I think at a certain extent, as these tariffs continue to sort of ramp up, and they're scheduled to on October 15th, and again in December, we have additional U.S. tariffs that are scheduled to be put onto Chinese imports. Eventually, this is going to hit the consumer. And when it does, I think we'll start to see the consumer confidence start to move downward, possibly.
But that's the debate, of course, right? I mean, of course, first of all, will those tariff increases indeed happen? I think that's a big question. Is there a possibility of a deal that might happen? One of the underlying assumptions could be that neither the U.S. nor China really has a great interest in escalating this topic in a big way. And wouldn't this issue of the trade disputes perhaps go a little bit to the background? Because the U.S. is entering the election year. I mean, why would we mess up the economy even more at this point in time? So why would we believe, or why would you be concerned about these trade disputes leading to these escalated tariffs?
I guess maybe I'm a little caught up in this week's news cycle.
Yeah.
We've had a number of events take place in terms of the U.S. putting visa restrictions on Chinese officials, on blacklisting certain Chinese companies, and of course we have Chinese negotiators in Washington as of tomorrow to try to work out a deal. I suppose the news just seems pretty stark. We were originally supposed to put a new set of tariffs on October 1st. We pushed that back to the 15th. I don't see anything substantive coming out of this meeting this week. And so I think, at the best case scenario is we see some tariffs come out on the 15th of October, and maybe the ones that are scheduled for December will be pushed off further.
So, Laria, I mean, we talk about US-China, but we had some news out of Europe also this week, right? We had a ruling by the WTO on Boeing Airbus. There's concern, and that has allowed the US government basically to increase tariffs on Europe. So is the nervousness in Europe around the tariffs beginning to impact on business confidence?
Well, definitely yes. If you make the same chart that you have here for consumer confidence and business confidence in Europe as well, you will see a similar large gap that is indeed quite unusual. But I wouldn't overestimate the importance of this week's news, in the sense that this issue between Boeing and Airbus has been there since forever, literally, and is expected to continue because there will be another ruling in the opposite direction, but the same in March. So I wouldn't.
Dutchman, I'm very concerned about the tariffs on cheese now, which, would be, and I think we all have some concerns. You as an Italian must be concerned too about some of these tariffs increasing on critical consumer products from Europe.
I don't sleep at night anymore. I mean, I'm an Italian abroad.
Okay, very good.
But I think, that part of the issue is that the news cycle is moving very fast, and it's very difficult to read the signals that are coming out. That there's a lot of noise there, and when we look at sort of the more fundamental economic indicators, maybe there is some cause for cautious optimism, let's say.
Yeah. Absolutely. I want to quickly back to a question that came in online, and again, I do encourage the audience to put in questions online, which was, I'm just going quickly back to the previous chart, which was the reading for Venezuela being 75, and the questioner said, well, I thought it would be a lot lower. 75 actually is really low. It's well below 100. It means there are many, many more negative consumers than positive consumers. Actually, Venezuela has come up a little. It was even worse before, but this is a bad reading. We have very few countries that would show consumer confidence much below that number. So, but it's a good point. We see the same thing in Argentina. It's 77. Again, those are really, really low levels, and important to go forward. It's an interesting question, by the way, how to compare these levels across countries, but that's for another conversation, and not right now. But Atman, I want to go back to this leading economic index that we mentioned a little earlier as being a very important part of the way that we are thinking about the economy. Maybe you can explain this chart for us, but I think particularly I want to know. It seems that the latest reading for this leading economic index is back in expansion territory, and that seems to me is probably an important factor why we tend to be a little bit more positive about the outlook, slightly more positive about the outlook than the consensus.
Yeah, so as you know, the leading indicators are short-term indicators of the business cycle, which are movements in the economy over 6 to 9 months. So the leading indicators that we're tracking at the conference board look ahead about 6 to 9 months and gives us a sort of assessment of the business cycle conditions. And in this chart, what we're doing is we're aggregating together the 13 different economies that we're tracking and looking at an assessment of the movement, the growth rate of that global leading indicator, and looking at whether it's going above or below its trend and whether it's accelerating or decelerating. So that gives us the 4 quadrants that we see here. So from right clockwise, we go the cyclical movement, kind of in the indicators move through expansion, slowdown, moves into contraction, and then recovery. So the way to read the chart is clockwise. And throughout most of 2019, we've seen this move into a slowdown territory. So the world economy, the leading indicators have kind of dropped below their long-term trend and they've decelerated. But more recently, we've seen this pickup also. It's not really kind of heading more into negative and contraction territory, right? So it's kind of coming back up and hovering in that slowdown area. And that's kind of consistent with an economy that's growing at about trend or a little below trend. So that's some cause for optimism looking ahead.
And by which countries is this driven? Are there specific countries that are actually pushing us a little bit back into that expansion territory?
That's the other piece of information that we look at. So are a majority of the indicators kind of pushing this index down or not? And we see that there's not a lot of concentrated weakness that's widespread. So, individual countries are moving around. The US LEI has been slowing. European LEIs have been slowing. There are pockets of weakness. So the most significant weakness that we see is in the UK LEI, which is actually, you don't see it here, but it's moved into and stayed in contraction territory. And that's the underlying our assessment that the UK, partly as a result of Brexit, will go into recession. There are other areas for the Euro area and South Korea that show some weakness. But again, that's a minority of the countries that we're following. So, overall, the outlook is, more of this kind of slow-growing global economy.
Right. So let's see what this all means for the overall outlook for 2020. So in this chart, and this is an opportunity for you as an audience to probably enlarge your slides by hitting the 4 arrows, because you can then better see it. At the bottom, you see the blue bars, which is referring to the 2020 outlook, and then 2019 is the little red dash that you're seeing here. So, as I mentioned earlier, globally, we see a little bit of an improvement from 2.3 to 2.5% growth. And this is driven by most of improvements in emerging markets, which is the block, sort of the lower block in this chart. You can see that the emerging markets and developing economies together go up from about 2.7 to 3.1 in 2020. Whereas the mature economies, which are at the top of this chart, are actually slowing a little bit further from 1.9 into about 1.6. Now, we'll talk a little bit more about the US and China and the Euro area in a little more detail later, but I just want to pick out a few, with the three of you, to talk about some sort of exceptional observations here. So, let me start with you, the UK, right? So, 0.2 this year. But actually, recovery next year. What do you know that we don't know here on this side of the pond?
I don't know what's happening in the UK. Did I miss something?
Right.
No, we expect, so this data that you see on the chart here are yearly data, but of course when we prepare our forecast, we look at quarters, and what we expect is actually a contraction in Q4 of this year and the beginning of next year. Then, of course, when you compute the overall data, it doesn't show as a minus sign yearly, but this is the reason why the forecast for growth is so low in the UK. And the reason for that is a combination of two things. On the one hand, there is, of course, the Brexit endless uncertainty. I mean, we're still 20 days from Brexit Day and we still don't know what's going to happen. Pretty much in the same way the day after the referendum where we did a Facebook Live and the uncertainty was massive. It didn't go down. So there is Brexit, of course, on the one hand, but there is also the fact that that there is a mature business cycle. that the UK didn't go through the recession that there was in the rest of Europe in 2012, and therefore it's been 10 years since the last recession. So it follows a bit the same cycle as the US. So so the combination of these two factors is, of course, increasing by the day the chances of a recession. If we look at the different drivers, if we look at different pieces of the economy, you can actually see that consumer confidence, unlike many other countries like Germany we named before, and Europe in general, has been going down a lot in the last 2.5 years. And for obvious reasons, because consumers have seen their prices going up because of the devaluation of the pound, and because of the large uncertainty on the economy. So this is a brief overview of what we think is happening.
Yeah, so a lot of it, of course, is going to depend on how well companies are prepared to deal with a potential no-deal Brexit, right? And again, it's the evidence is not all that clear. Some companies are very well prepared for this and deal, prepare themselves for moving stuff to Europe so that they can keep operations going. But I guess that a lot of other companies, particularly services companies who can't move inventory around, will still suffer a lot if a no-deal Brexit would happen. And that could significantly impact the numbers that we're looking at, right?
Right, and there is very mixed evidence on companies. You can read really everything. You can read companies that have found different suppliers so they don't have to deal with supply chain disruptions, but you can also find companies that are still struggling and they don't know how to deal with it. And I would think that the small companies are more in trouble because you have less resources, a smaller network to react. So it is not easy, and I wouldn't expect companies to be prepared and 1st of November.
But for sure, our recommendation would be for companies to prepare because there's so much uncertainty on how this exactly is going to play out. So it's an issue that should not be underestimated. Now let's move a little bit, Ataman and Eric, to Japan because that's the other sort of big outlier. Slow growth this year. Japan is not a fast grower, but 1.2% in 2000. It was 1.2% this year, 0.5% next year. That's actually quite a significant slowdown. What's been causing this? Go ahead.
Well, the LEI for Japan just came out this morning, and I was looking at it before I came into the studio, and there was another large drop there. And that has been part of this pattern of falling LEI, and a lot of it has to do with the weakening outlook. But Japan also instituted this consumer tax in October, and that was expected to cause a contraction all along. But the underlying trend is not very strong either. So it's likely that this contraction is going to develop, perhaps short-lived in the early 2020 period.
Right. Eric, any comments on Japan?
I think the consumer tax was definitely one of the drivers here. People have been discussing it for a while, but they finally pulled the trigger on it just about a month ago or so. I think, also for next year, there's been talk about a limited sort of runway for stimulus in Japan as well. In terms of, the government's been grappling with high debt levels for a while, and there's been some real actions to try to limit that debt growing any further. So their ability to sort of deploy fiscal stimulus, at least in 2020, is limited by what appears to be a real adherence to more sort of commitment to not running a massive deficit for next year.
So the fastest grower in this chart is India, among the largest economies, still improving a little bit from last year, 6.3% growth. Is India going to rescue the global economy? Your views?
I don't think India is yet large enough to really move the dial on the global economy.
In terms of GDP, it's a big country.
Well connected enough. No, exactly. Yeah. So I don't think it's going to be the savior that people maybe might like it to be. But certainly we do have some optimism about the performance of the economy next year.
It's a large economy, but it's still about 8% of the global output, whereas, that's about half as big as China. Mm-hmm. So despite the population size and the size of the economy.
Yeah, we had elections in India, of course, right? So, there's sort of a new positivism for a new period of under Modi's government with more economic reforms. He started some of those economic reforms earlier. So I think there's also some optimism that the economy will continue to grow. But it's coming, to your point, it's a small economy in terms of size of GDP. It's also a poor economy, so you can grow fast if you come from low levels. And a lot of this growth is concentrated in services. and not in the manufacturing sector, which was really the driver of growth in the case of India. So, in the case of China, sorry. So India is not really going easily to step into the footsteps of China.
I think the biggest challenge in India is the manufacturing sector.
Yeah.
It's sort of this structural aspects of India is not really allowing for manufacturing to really take off.
So quickly wrap up this chart, Ataman, Brazil, Mexico, and then we will go into some of the further detail for other regions. But these countries, these two countries, and actually Latin America as a whole, although I think it's a really mixed bag, is that growing still way below their potential? And when are they ever coming back to their potential growth, which is probably around 2-3%, or is the potential ultimately come down on them? And is this just another lost decade that we're potentially looking at?
So that's a million-dollar question.
Yes.
We would project a higher sort of potential for these economies, based on their labor supply, based on some improvement for their productivity, as they get their house in order. But the longer that these lower growth rates continue, the chances that potential also comes down. And we do project these improved rates for next year, but those are still pretty low growth rates. There are sort of special reasons within the different economies around there. Brazil just went through an election, but the sort of optimism on more growth and business-friendly environment is unclear whether that's going to materialize or not. Mexico has its own sort of issues there. It is closely tied to the U.S. economy. So generally, as the U.S. economy picks up, we do see the Mexican economy improving, especially if at the same time, oil prices are improving. So they get a positive shock from oil prices. But again, it's not really enough to push them back up to potential.
And large differences across the region, right? So I think, last year it was really these larger economies, Brazil, Mexico, and of course Argentina and Venezuela, much worse, were suffering. But then on the other end of the region, you had, Peru and Colombia and Chile doing quite well. But now recently we actually have seen bad numbers coming in from Chile, bad numbers in from Peru. Our consumer confidence index this morning from Peru was down big way. So it also seems that the region as a whole seems to be drowning into a little more of a slowdown.
Yeah, I think part of that might be related to this industrial downturn that we're talking about.
I think that's a really good point.
For emerging markets as a whole, but also, given that they export a lot of commodities, the down cycle there kind of affects them. But that also creates kind of that silver lining looking ahead, right? As we expect the industrial downturn to bottom out. It will, hopefully provide some more impetus for these.
Now, I would have moved on, but I can't get away from asking you about Turkey, particularly because Turkey is in the news, of course, the last few days, big way. It's seen a big contraction here in 2019. We now see a bit of an uptick projected in 2020, but the political environment now becomes a lot more tense, potentially globally. Could this have a big impact on Turkey's economy, or do you think that the political and the economic environment are really detached and we should perhaps worry less about it we worry a lot about it, but less from an economic point of view?
Well, you're asking me because I was born there, but that was a long time ago.
Well, I'm not asking you for more reasons than that, but
No, still, I think the negative impact of all those things has already shown up for the Turkish economy. They have seen a contraction, maybe a slight recovery, but it's, again, another one of those countries where it's having difficulty to jump back up to the higher long-term potential rate. I think the political issues are both internal and now external, sort of regionally with the Middle East. Those are all things that are kind of holding back, the economy from reaching its potential. And there are sort of, significant questions about the macroeconomic policy creating, a favorable and smooth environment. There's just a lot of volatility.
All right, so let's, before we wrap up this, we're going to move a little bit more into the US and Europe and China separate now, but we have one more poll question to wrap up this global section, and that poll question should be coming up now, and hopefully the discussion has helped you to inform a little bit more on this. So where do you think the major threats to global growth over the next 12 months will come from? Obviously, there's a lot of risk here. Do you think it will come from the trade disputes? Do you think it might come potentially from wage inflation, rapid increase in wages, the rise in oil prices? an erosion of profits, a recession in the United States, Brexit, which we talked about, or other geopolitical or geoeconomic risks. So think a little bit about this. There are multiple answers here, but we'd like to see sort of where your assessment is of all these risks and where you think the biggest risk is going to be. Okay, and we'll give it sort of, 5 more seconds. 5, 4, 3, 2, 1. Great, thank you. So almost 2/3, 62%, 63%, still worried a lot about the trade disputes. Second is 22% who think about a risk of recession in the United States, and the other risks are less. So the trade issue, Eric, you and I discussed this a little before. Maybe you can respond to it. It seems you are right in saying we have to be very concerned about it.
It doesn't mean that I'm right. It means that just more people agree with me.
Yeah.
We'll see what happens next year.
Right.
This story has just gone on and on and on for 2 years. The U.S.-China element is just a part of it. You had the NAFTA renegotiation. We have what's happening again with Boeing, and then Airbus. The Airbus decision is going to be made in early 2020 at the WTO. I'm not optimistic that the story is going to slow down next year, even though it's an election year. To the extent that the president's base, especially in agricultural, aren't damaged too much.
But I think you're making a really important point, and that is that it goes on and on and on. And we talked about consumer and business confidence before. But if the consumer keeps hearing this, for the time being, this is just noise. And one day they hear this, and the next day they hear that, and they just look at their jobs and their own environment and their income, which is very important for them. But I think if at some point they get this idea that this is going to be really bad, and that ultimately this will impact them, consumer confidence could suffer. And I think in that sense, I think that's why I was using the word right. My biggest concern about this outlook of ours is that this drumbeat will begin to emerge over the next few months. And that's why I think it doesn't make sense for the US administration or for the China administration to let this flare up, because that would ultimately potentially impact the confidence of consumers.
I think also that the trade war, if that's what you want to call it, or trade conflict, is having to compete, with a lot of other noise that's on television in the U.S. as well. So consumers, to a certain extent, might be distracted by some of the things, whether it's formerly the Mueller investigation or some of the other investigations that are ongoing. There's a lot to cram into a 1-hour news program at the moment, and trade may not be at the top of the list.
Okay, so we need to speed up a little bit now, but Ataman, this one hasn't come through. Why don't we, Eric, go straight into the US outlook, and then we have a little bit more time to talk about the euro and China in next month's webcast, and we come back in big detail about the US. But no recession in our forecast, right?
That's correct.
So where is the driver of growth coming from? What is going to help the economy push into, what is this about? I can show you the next chart, which has the numbers showing us into about a sort of 2% growth rate in 2019.
Well, so growth we do see as moderating to a certain extent, and sort of converging on its long-term average of about 2%, which is a healthy place to be. The reason that we do see a slight deceleration, I think, is because some of the consumption forecasts that we have for the coming year are expected to be just a little bit softer. The health of the labor market, while solid for the next 12 months or so, is likely to be a little bit softer as well. On the downside, we have business confidence, which is as we discussed earlier, not doing very well. And as a function of that, business investments also not really coming through in the GDP numbers. And one silver lining that we have been watching is the housing market. We've seen the number of permits and housing starts start to tip up, which we think will sort of manifest itself in greater residential investments.
Yeah. And that's actually where potentially we're having one more rate cut in the forecast here for the US, and that may not do a lot to investment. The investment is much more dependent, sort of non-residential investment is much more dependent on the trade disputes that we talked about earlier. But for mortgages, it might help. And there we could actually see an uptick in that housing that you were referring to.
Sure, yeah. The mortgage rates declining certainly does help.
One question here online, Ataman, maybe you can deal with it, and that is, what do we expect from manufacturing growth and industrial production in the US? Because that is an important underlying driver. It is what happens in industry is a critical determinant of our leading economic index. So, we talked about this bottoming out earlier. How would that play out in the United States for industrial production?
We are talking about this gradual bottoming out of the industrial production numbers and the manufacturing sector finally improving, early 2020. And that's partly as, the trade environment doesn't kind of escalate and get worse. That helps with some of the business confidence numbers, so those factors can return to production. And we don't really see kind of a major movement in inventory surprises, so that also supports the sort of underlying industrial production returning. But for the US economy, the industrial sector is not as large anymore. So for the overall economy, it's less important. In terms of
that's true, but there's a lot of services around it, around industrial production, where the U.S. actually is relatively strong, right? So, professional business services, we actually produce a lot of those and actually export them globally. So we're dependent on manufacturing. And I think the other thing that's important in manufacturing, and that might actually help the U.S., is that we finally begin to see technology and innovation drive itself a little bit towards productivity growth, right? We have somewhat faster productivity growth in the U.S., and a lot of that is also driven by the manufacturing sector.
Exactly.
So I think that may also play a role. Ilaria, let's go back to Europe, because I want to go back to this topic of industrial production in Europe. We talked about it earlier. A lot of this is in Germany, not only in Germany, as you said, but Germany is an important part of this. And this slide is sort of explaining that a lot of industries are sort of moving to the left side here of this chart, which means they have been seeing negative growth. And some of those are large industries, notably automotive here. So how widespread is the problem in Germany? And again, what is the potential for a possible, recovery, or at least a bottoming out by the end or the beginning of next year?
Easy question. So I put this slide first because I wanted to start with Germany, because obviously if Germany sneezes, Europe catches a cold, and so everyone is now looking at Germany, also because Germany had negative growth in Q2, and so the fear of a recession is of course there. Now, what you see here is indeed industrial production, and I put a comparison between the end of Q4 of 2017, which was in a way the short-term peak in industrial production in Europe and in Germany, with the latest data available, so 2019 Q2. Now, to your last question, this is widespread. You can see that the automotive sector, which is what everyone obviously talks about, is suffering, and this is one of the largest sector in the German manufacturing, and so it had a negative growth of about 10%, and the size of the bubble tells about the size of the sector. But this is really not the only one. So you have here about 20 sectors, 20 categories in the manufacturing sector, and 15 of them have a negative growth. So the only one literally that is on the large side and showed positive growth is actually other transport sector, which basically means trains and airplanes.
That includes Airbus, right? Yeah.
Correct.
And everything around it, yeah.
And exactly. Whereas if you look at on the left-hand side of the chart, you have, besides automotive, other big sectors like machinery equipment, electronics, food, pharma, electrical equipment. So these are sectors where the export is actually strong. Is this going to level out? We expect yes. We expect that. The trade disputes will, we said the problems are two there. On the one hand, there is the trade disputes and in general the decline in trade growth and the structural challenges. So I think we can have some touch of optimism on both, because on the one hand, you can see, we expect that the trade disputes will somehow be solved or at least not become worse, and this might push confidence up again in the business sector. And on the other hand, we have seen a little bit of productivity growth in 2018, and in our forecast, we expect that to become even bigger.
So
I wouldn't be over negative.
Let's look at this chart here, which I find very interesting. Again, so the blue bars is the outlook for 2020, and the red dashes is 2019. So there are really two countries that are critical in this respect to rescue Europe. Well, three actually. One we talked about which was the UK. But again, we see that those numbers are really coming down quite a bit for 2020. But the two where we actually see an improvement compared to this year is Germany, and the other one is Italy. Those are the two large economies that we really should be caring about. Those are also the two that probably are at the biggest risk of things going wrong and turning into a recession. So what is driving your optimism that we can actually avoid it?
So on Germany, I already said something. If I think about Italy, I think the 2019 has been, I mean, especially until Q2, has been a very hard year. Think about the policy dimension. So the government fell, and this government, the new government that is now in place, has pushed consumer confidence up because the main mission of this government was to avoid increasing VAT. At the same time, unemployment has been going down in the last quarter in Italy. So you can see that the domestic part of the economy is somehow getting better. Now we're still talking about very weak growth rate. I mean, 0.5 is far from an ideal growth rate, and this is because the long-term challenges of the countries are far from being solved, and there is no government that can solve those in a quarter or even a year. So in slight optimism on Italy, but of course with all the context in mind. If I look at the average, basically 2020 will be a sort of prolongation of 2018. So a little bit of improvement of business confidence perhaps, but all in all, growth rate 1.3%, the same as now in the euro area. Funny thing is that you can compare small and big countries. So all of the big countries are below the 1.3%. France, Germany, and Italy. UK, we talked about, separate issue. So what is driving the 1.3 is the small countries that are more dynamic on this part of the world.
Yeah, and some of the East European countries, there's only one here in this slide, which is Poland, which obviously is a larger one, but there are a lot of smaller ones, which also show more positive growth rates, but also very much challenged by rapidly rising wages, hugely tight labor markets, very exposed to global industrial production as well. So those are things that obviously we need to watch very carefully.
Well, one thing we didn't talk about is the role of policy, and in the European economies, of course, European Central Bank has a strong role, and they have been kind of moving towards creating a more accommodative environment through monetary policy. So that will likely support the positive outlook.
So, Elia, do you think that these very low rates, negative interest rates in Europe, and very easy monetary policy is going to help?
I think it continues to help at a decreasing rate. So the longer these measures are there, the lower the marginal impact. The problem is that monetary policy, I mean, we have this long-standing institutional problem in the euro area that, we have one monetary policy and 19 different fiscal policies, and it was explicitly said by Draghi last week in the European Parliament that the reason why monetary policy is coming in to support the economy again is just because fiscal policy is not doing it, and if fiscal policy did it, it would be much more impactful than monetary policy. So it's a suboptimal choice with a small positive sign.
And that delivers some message to the US as well, which obviously is not as easy in terms of its monetary policy as Europe, but it's going in the same direction. So these are important messages that you're delivering here for the US audience too. Now let's wrap up the last few minutes on China, but Eric, there's one question here that might be a good transition, which is related to agriculture. How much of an impact does the agriculture export market have on the US economy? But it might, it's obviously also a very important part of the whole trade disputes.
It is. It's not at the core of the trade disputes, but I think it's one of the areas where it's sort of manifesting itself the most strongly in the U.S. economy. I can't recall how large a share of GDP the U.S. agricultural sector is.
Oh, that's very small.
But it's concentrated.
It's part of the exports. It's much bigger.
It's concentrated in location, and it's highly export oriented. Yeah. And so the trade dispute has really affected this sector in the U.S. And so U.S. farmers, for instance, have really been shouldering a lot of the pain that the U.S. has seen as a function of the volatility in the U.S.-China relationship.
Okay, let's wrap up the last few minutes. We've got about 5 minutes for this on China. The question came up earlier in our webcast about the rebalancing of China's economy, right? So we see this rapid decline, but silver lining might be that we get this sort of industrial restructuring and that consumers are actually beginning to recover. Is it really what we're seeing in the data?
I mean, the data are volatile. We have seen a bit of a difficulty in transitioning from sort of more infrastructure-led growth to a more services and consumption-oriented growth pattern. And this is reflected, I think, in some of the higher frequency data that we've been watching. For instance, you look at the Global Consumer Confidence Index, or even the Chinese NBS's Consumer Confidence Index. It indicates a fairly high level of confidence among consumers in China.
But if you look at this chart here, right, I mean, it's kind of interesting to see that actually net exports have moved back into positive territory. Investment capital formation, as it's called here, has come down a lot this year, and that has a lot to do with this industrial cycle that we're talking about. But then the consumer really has come down as part of this, right? So, and latest our consumer confidence number this morning for China and our global CCI was just down a little bit, but our consumer confidence numbers out there in China, which actually have shown a bigger decline.
And that's my point. Is even though you see these confidence measures quite high, if you look at the retail sales numbers, if you look at auto sales numbers and things like that, they're either decelerating, they're not growing as quickly, or they're taking it on the nose, especially with auto sales. So, to a certain extent, the Chinese consumer is really not stepping in to pick up the slack in terms of the industrial sector.
And look at this next chart.
Exactly.
Right.
So this is some work that we've done in terms of the debt burden that Chinese households are sort of grappling with. There has been a tendency to really drum up a lot of leverage at the household level inside of China as people borrow more and more money to buy apartments and houses, things like that. Previously, the down payment requirements were actually relatively high in China for buying property, but they've come down a lot in recent years, which corresponds to this higher leverage. And so a greater proportion of Chinese households' money is going towards servicing these debts. So even though that they may be confident, the erosion of the size of their disposable income is limiting their ability to sort of dig into the cash register at their local store, and that money is instead being funneled away towards banks to service their debt.
Yeah. So that's a pretty big issue to look at in going forward. Yeah, and then so we have this significant slowdown in economic growth in China, much lower than the official numbers. There are different ways to look at this. There's some alternative estimates which come down even further. I think indeed, and we talked a little bit about that, is what is driving this recovery? Is it a healthy restructuring, or do we actually expect that China's government is going to step in to avoid a further decline and just prop up the economy again? Where would you put the balance between these two drivers of faster growth?
Well, I think both are at play here. I think that, structurally, the rebalancing of the economy in terms of eliminating some of this excess capacity is good in terms of sort of long-term structural growth. But in terms of limiting sort of the floor, avoiding a hard landing, the Chinese government has and will continue to try to
use these instruments.
Correct. Whether it's monetary policy or whether it's fiscal policy, and they have the room to do that. We're currently looking at our model in terms of how we forecast and make estimates of China's growth numbers. And I think that early next year we may redress this issue in terms of whether or not growth has actually been operating or coming in even weaker than we had previously thought, which is reflected in this chart here.
We need to wrap up. There's one little final question. I want to make sure that we address all the questions you're asking. This is a question how consumer confidence in China and actually in Asia as a whole is affecting animal protein consumption. Now, that's an interesting question. The number that I would throw in here, actually, is that one of the things that came out from our Global Consumer Confidence Index that we had this morning released is we ask a lot of questions around what are your biggest concerns. And, of course, these are quite often about jobs and the economy and so on. But actually, concerns about global warming are going up, even in the case of China. We see it globally, we see it very strongly in Europe, which is no big surprise, but also in the US. And I think so there's a certain amount of awareness that people feel that the way that they are consuming needs to begin to change. And this might also have a potential impact on the way that consumer growth is going to be driven in China, right? Yeah,
definitely. There's a lot to a lot of layers of that onion to sort of peel back.
Yeah.
In terms of the original question on a protein and how that responds to consumer confidence, there's a complicated situation right now in China in terms of protein, or animal protein especially. You have a pretty rampant disease that's affecting the swine, the pig population. And so it's driving up prices. And then, of course, you have, to a certain extent, tariffs that are on U.S. imports of pork into China. So even though global consumer confidence in China remains high, and that pork, which is a very important protein in the country, should be benefiting from that, especially because it's an affordable luxury, if you will. There are supply dynamics that are coming into play as well.
It's a good topic, and we'll come back to it at some point in time. We have to wrap up. We're at the top of the hour. A lot more to talk about. The good thing is that you can actually see a lot of this material coming back at the Conference Board website. You should just go to our website and then go to Global Outlook. The URLs here at the top. You can download the data, you can look at a summary of the report. There's another report appearing with a lot more detail by region later this month. There's the infographic that I referred to earlier. You can download that actually right now, so that gives you a really nice summary. So a lot more to come, and of course also in our webcast we will deal with that. Wrapping up, please again join our Economics Watch every month. Next month, it's every second Wednesday of the month. Next month, on November 13, we're going to talk about labor again in the United States. Our labor market team has put out a terrific new report, not only looking at where are the labor shortages, but also what are the potential solutions to begin with labor shortages that we're seeing in the US, and frankly a topic that is relevant for Europe and for a lot of other countries as well. We'd like to hear from you, of course, in the brief evaluation, so please give us further feedback on this. And finally, let me thank again the panel, Eric and Ataman and Ilaria and Brussels, for joining us. And thank you for joining our monthly Economics Watch. My name is Bart van Ark at the Conference Board in New York.